As of right now, Friday, May 1st, 2026, at 1:28 p.m. Eastern Time, the markets are active and trading is in full swing. However, it is important to clarify a specific point of technical reality for anyone looking to pull up a chart on their Fidelity mobile app or Robinhood app right this second. Strive Inc., the entity often associated with the prominent Strive Asset Management founded by Vivek Ramaswamy, is currently a private enterprise. Because it is not a publicly traded corporation listed on major exchanges like the NYSE or NASDAQ, there is no live intraday ticker symbol or a fluctuating share price to report in the same way you would track Tesla stock or Apple stock. If you are seeing a ticker symbol like STRV or similar on various investing sites, you are likely looking at unrelated small-cap entities or international listings that do not represent the Strive Asset Management firm. This distinction is the first major gap between expectation and reality. Many people hear the noise surrounding this company and assume they can simply jump onto a Robinhood trading platform and buy in, but the reality is that Strive operates as a private disruptor in the massive world of institutional wealth management. While you cannot buy individual shares of the parent company today, the impact Strive is having on the broader market and individual brokerage accounts is immense. They have positioned themselves as the antithesis to the ESG movement led by giants like BlackRock and State Street. The common belief is that index funds are neutral, passive vehicles that just track the market. Strive challenges this by arguing that traditional passive investing has become a tool for social engineering, and they are gaining massive traction by offering an alternative. This creates a fascinating tension in the market. While the world watches the volatility of Nvidia stock or the latest swings in Tesla stock, a quieter shift is happening in how people choose to allocate their capital through Schwab Intelligent Portfolios and other online investment tools. People are starting to ask not just what is in their portfolio, but what those shares are doing in terms of corporate governance. The recent movement we are seeing in the sector isn't measured in cents per share, but in billions of dollars in assets under management flowing away from traditional providers. This institutional activity is a direct reaction to a changing macroeconomic climate, where investors are becoming more protective of their returns. We are seeing a surge in interest for self-investing and interactive brokers trading among those who want more control over their proxies. This isn't just about a single company, it's about the plumbing of the entire financial system. When you look at the growth of SoFi Invest or the way people use interactive brokers platform to manage complex strategies, you see a growing desire for clarity. Strive is tapping into this by focusing on what they call shareholder primacy. They are essentially betting that a large portion of the American public wants their investments to focus solely on excellence and profit rather than social metrics. Expectations for Strive were initially that it would be a niche player, a small ripple in a very large pond. The reality is that they have grown at a pace that has forced the big three asset managements to sit up and take notice. This growth is a catalyst for the entire sector. We are seeing major reaction from retail investors who are moving their Fidelity IRAs and Fidelity Wealth Management accounts into products that align with this pro-excellence mandate. The trading volumes in their specific ETFs have shown that there is a hungry market for this. This creates a curiosity loop for the average investor. If the traditional way of investing is being challenged, what does that mean for your long-term retirement? If you are using a SoFi robo-advisor or intelligent portfolio, are you actually getting the best return, or are you paying a hidden cost for social agendas? This is the deeper analysis that most people miss. They focus on the daily price action of a hot ticker like Nvidia stock, but they ignore the underlying forces that govern how those shares are actually voted in boardrooms. Let's talk about the business model for a moment. Strive earns its revenue through management fees on its suite of exchange-traded funds. This is a high-margin business once you reach a certain scale. They are competing directly with Fidelity ETFs and Fidelity mutual funds. By keeping their overhead relatively lean compared to the legacy giants, they can remain competitive while being very loud in their marketing. They aren't just selling a fund, they're selling a philosophy. This is why you see so much engagement on social media and why people are constantly searching for investment help related to their products. The company's recent activity has focused on expanding their product line to cover not just broad market indexes but specific sectors like energy and technology. They want to be the one-stop shop for the anti-ESG investor. Institutional activity in the space is also picking up. We are seeing more individual brokerage users and even some smaller pension funds starting to look at these alternatives. The reality is that the financial industry is built on momentum. Once a few large players move their money, others follow for fear of being left behind. This is the same psychology that drives the massive moves in Tesla stock or Apple stock. It's a combination of fundamental belief and a fear of missing out. However, the risk here is also real. The legacy firms have trillions of dollars and decades of brand loyalty. For a private firm like Strive to truly unseat them, they have to maintain their growth rate without making a major operational mistake. They are essentially fighting a war on two fronts, one for the hearts and minds of retail investors and another for the cold, hard math of superior returns. When you look at the Fidelity trading platform or the Robinhood app, you see a democratized version of finance that didn't exist 20 years ago. This ease of access has allowed companies like Strive to bypass traditional gatekeepers and go straight to the consumer. They use the same digital tools that have made SoFi trading platform and Robinhood investments so popular with younger generations. This sector momentum is undeniable. We are in a period where the very definition of a fiduciary is being debated in courts and boardrooms across the country. This creates an environment of uncertainty, and in the market, uncertainty leads to opportunity for those who are positioned correctly. Comment below how many shares of an energy or tech ETF you currently hold in your portfolio right now. I'm curious to see if you prefer the broad market approach or if you're starting to lean into these more focused thematic investments. Also, let me know if you think the shift toward pro-excellence investing is a permanent change or just a passing trend in the wealth management space. Looking at the future outlook, there are several scenarios to consider. If the current political and social climate continues to polarize, Strive's message will likely become even more potent. This could lead to a massive influx of capital from Robinhood crypto users or interactive brokers account holders who are looking for a place to put their profits. On the other hand, if the major asset managers like BlackRock successfully pivot or greenwash their way back into the good graces of the skeptical public, the growth of smaller disruptors might hit a ceiling. The catalyst to watch will be the next major earnings season for the S&P 500. If the companies that Strive is vocal about, those they claim are distracted by social issues, begin to underperform their peers, it will be the ultimate validation of their thesis. The risks are also tied to the regulatory environment. There is always the possibility of new legislation that could change how proxy voting is handled or how ETFs are marketed to the public. If you are someone who likes to invest online or is looking for online investing tips, you have to stay sharp. The reality of the market is that it is a constantly evolving organism. What worked 5 years ago when everyone was using fidelity brokerage in a traditional way might not work today in the era of Robinhood fractional shares and high-speed interactive brokers fees analysis. You have to be willing to look past the surface-level news and understand the structural changes happening in the background. The business model of a firm like Strive is also dependent on its ability to attract and retain top talent. They are competing with the biggest names in the world for analysts and fund managers. This is why their public image is so important. They need to prove that they are a stable, long-term player, not just a temporary reaction to a specific cultural moment. Their past performance has been strong in terms of asset gathering, but the true test will be the next 3 to 5 years of actual fund returns compared to the benchmarks. Investors will stay for the philosophy, but they will only stay long-term if the numbers make sense. This is the ultimate reality of the financial world. In summary, while you can't check the live price of Strive on your Robinhood app today, its presence is felt in every corner of the market. We've seen a clear contrast between the expectation that legacy firms would dominate forever and the reality that a small, focused disruptor can change the conversation. We've looked at the institutional activity, the growth of thematic ETFs, and the way retail platforms like SoFi and Fidelity are being used to fuel this shift. The market narrative is changing from one of passive compliance to one of active, value-driven choice. Whether you are using Schwab Intelligent Portfolios or managing your own individual brokerage, the way you think about your capital is likely being influenced by this battle for the soul of the stock market. The tension between what the market expects and the reality of investor sentiment is where the most insightful analysis lives. Keep your eye on the flow of assets, watch the proxy votes, and never assume that the biggest players are untouchable. Authority in this market comes from understanding these deep structural shifts before they become mainstream news. Stay focused on the excellence of the companies you own, and the returns will usually follow. This isn't just about one company, it's about the future of how we all build wealth in an increasingly complex world. Expect the unexpected, but always verify the reality of the data. That is how you stay ahead in the market that never sleeps and never stops evolving.